Here's the thing, you should buy index funds instead of stocks, and this is why. When choosing between index funds and individual stocks, several factors make index funds a more compelling choice for many investors, particularly for beginners and those seeking a lower risk approach. Index funds diversification. Index funds offer instant diversification by holding a basket of stocks that track a specific market index. This spreads your investment across numerous companies and sectors, mitigating the risks associated with any single company's poor performance. Investing in an index fund tracking the S&P 500, for example, provides exposure to 500 of the largest U.S. companies. Lower costs. Index funds are passively managed, meaning they simply replicate the performance of a benchmark instead of having managers actively pick stocks. This results in lower expense ratios and fees compared to actively managed funds, allowing more of your investment returns to stay in your pocket. Historical performance. Over the long term, index funds have consistently outperformed the majority of actively managed funds, even after accounting for fees. Research indicates that the average return of the S&P 500 since 1957 has been about 10% annually. Simplicity and ease of management. Index funds simplify investing as you don't need to research individual companies, track financial news constantly, or actively manage your portfolio. This makes them a suitable option for busy professionals or those new to investing. Individual stocks. Potential for higher returns. Investing in individual stocks offers the potential for higher returns if you can successfully identify undervalued companies or growth opportunities that outperform the broader market. Greater control. Buying individual stocks gives you complete control over your portfolio, allows you to invest in companies you believe in and those that align with your values. Learning experience. Researching individual companies can be an intellectually rewarding process and help you gain a better understanding of business fundamentals and market dynamics. However, investing in individual stocks also presents several challenges. Higher risk. Individual stocks carry higher risk compared to the diversified index funds, and as the performance of your portfolio is directly tied to the success or failure of a few selected companies. Significant time and effort. Successful stock picking requires extensive research, analysis, and ongoing monitoring of companies and market trends. Potential for underperformance. Despite the allure of higher returns, many individual stocks underperform the market, and only select few contribute significantly to the overall market gains. Emotional challenges. Investing in individual stocks can be an emotional roller coaster, making it difficult to stick to a long strategy during market downturns and potentially leading to impulsive buy-sell decisions. Conclusion. When individual stocks can be appealing for some investors who are willing to dedicate the time and effort to thorough research and risk management, index funds offer a more accessible, diversified, and cost-effective approach to long-term wealth building for most investors. For many, a combination approach might be suitable, where index funds form the core of the portfolio for diversification and stability, while a smaller portion is allocated to individual stocks and for potential performance.